Hello everyone, today we're going to talk about how interest rates work and what you're buying, how that affects what your interest rate could be. So here we go. So I've said it before and I'll say it again, there is no one size fits all interest rate. So if you go to a lender and you say, what's my rate? It doesn't matter. They need to know a lot about you before they can figure that out. So what are the different things that go into your interest rate when you are buying a house and you're getting your pre-approval, or you just found that property and you're ready to lock in your interest rate because you know they're slowly on the rise, which right now they have been and they're going to continue to do so. There's nothing showing that that's going to stop anytime soon. What's going to go into it is what is your different details, not exactly your like where you work and what you do and who you are as a person, you know, ethnic background and all that stuff. None of that goes into account when it comes to your interest rate. What does go into account is what your debt to income ratio is. So how much money you make versus how much money you got going out every month. How much money you're putting down. Are you doing an FHA loan program, 3.5% down? FHA is going to be priced a little different than conventional, which is going to be priced a little different than a VA loan if you're a veteran. There's going to be things like, are you buying a primary residence or are you buying an investment property? Is this going to be a stick-built home, you know, regular construction, or is this a manufactured house? So all these different things come together when you get your scenario put together and it gets priced out. What I mean is most companies have an engine. You put in the details of a transaction and the engine will actually pull up what the current interest rates are for that specific scenario. Because all those little things I mentioned, what your FICO score is, how much money you're putting down, where you're buying, how many units is the property, all those things adjust what the current interest rates are. Usually up. They usually have like a base number and then there's adjustments that go from there. So are you putting 10% down versus 20%? That might change the cost of your interest rate. Are you buying a second home? Is the property a condo? Things like that. So that's what's going to change interest rates. So if you ever hear on the radio or you see on a commercial saying, this is the interest rate we're offering for this, that, and the other thing, which I don't know if you've noticed, but I have, you don't hear too many commercials for that anymore because most of those were for refinances. And once the interest rates went up, almost all refinance business died. So I'm sure a bunch of companies just closed up their doors and disappeared. And that happens every time interest rates go up. They go down, companies appear, they offer stuff super low, they try to get as much as they can. As soon as they go up, they're out of business. So that's not the rate that you're going to get. It's just not. It's some unicorn scenario that nobody really qualifies for. So when you go to get your interest rate, or you're looking to get, mostly you're in contract on a property, you're ready to lock in your interest rate, your whole scenario is going to go through this system to see what the interest rate is. So it's going to change from person to person, from scenario to scenario, on what you're looking to do. Now I'm currently doing a transaction where somebody's buying a second home and it also happens to be a condo. And the interest rate on that was almost a whole percent higher than, maybe not a whole percent, probably about 0.75 higher than if someone was buying it as a primary residence. So just things to be aware of. If you're a first-time home buyer, a lot of that kind of stuff's not going to matter unless you're buying like let's say a 4-unit and you're going to live in one of the units. Or, you know, something like that. If you're not just you buying a condo or you buying a stick-built home, there's going to be all these adjustments. So like a condo, if you're buying it as a primary residence or a secondary home, it's going to be a higher rate just because it's a condo. That's an adjustment there. Now, if you're buying a home and it's in a planned urban development, also known as a PUD, which basically just means you're buying a stick-built home that has a homeowners association associated with it, that doesn't usually affect your interest rate, believe it or not. If you're buying a manufactured home, like a double wide somewhere and it's on its own land, its own foundation, that interest rate's going to be a little higher. So there's just adjustments that happen to the rate. Now, I think it's important that people know that all these things go into your interest rate, because then when you hear something on the radio, you see a commercial, you won't just think, I want that rate, that's my rate. That's not how rates work. And rates do shift up and down with the market. They go up and they go down, and over time, especially over those maybe the last 2 years, they've slowly been going up, and now they've gone up to where I'm seeing rates now in the 5s and 6%, which I have not seen for probably about 6 years. So that's kind of where we are in the rate environment. But you know what? If you get prepared and you do what you need to do to be the best scenario, to build your best profile you can still get your best interest rate. What's the best interest rate that you can get that you qualify for? And that means taking care of your credit, making sure you have the best FICO scores you can have. You pay your stuff on time, you keep your FICO scores high. It means that you have some money to put down, maybe not a lot, but that can change some things too. Maybe you're looking at FHA versus conventional. There's a little bit difference in the rate there. Usually at pretty much any one company, you're going to see variations between loan programs. Taking care of your credit, having some money down, those are things that are going to help with your interest rate when you come to it. But also not shopping at your exact max, because when we have a rate environment where the rates are slowly ticking up, your maximum is going to drop as the rate goes up. It's just a natural function. So if you can shop below your max, now you've got some headroom in between where you're shopping and when you actually get that property that you were looking for. You got to have that headroom, otherwise you lose that max thing, and then you go to find a property and this is the one you said I was qualified for, and now the rates have gone up and now I've got to pay off a credit card. Now I've got to do this and that just to get this house. You kind of have to shop below your max right now. But anyway, just some information on interest rates, how they work, how they're kind of calculated depending on the company. I mean, they can be different from one branch to another branch at the same company, just because pricing and stuff is different. What most people may not know is lenders really get paid on that interest rate in the loan amount. They're percentages. That's where all the profitability in lending really is. I mean, there's other fees with lending. So if, you know, there might be a processing and underwriting fee. Those are pretty typical. You see those across the board. When it comes to the lender now, I'm not talking about title and escrow and all those third-party fees. I'm talking about the lenders themselves. They usually have those fees in there. They're not really making a ton of money on those fees. I mean, it might be, you know, $1,400, $1,500 typically across the board. So they're making some money, but where they're really making the money is a percentage, the interest rate. It's built into the system, okay? Because they borrow money at a smaller interest rate. And when they're reselling that money, they're lending that money, it's at a higher interest rate. That's where the profitability is. So if profits, like right now, where banks are having to become even more competitive with each other, just to get rates down a little bit, profitability sometimes gets cut down. So people may not be making as much money. Like loan officers may not be making as much money to stay competitive. But that's where they make their money. They make it in the loan amount. So a loan officer doesn't make any money until they close a deal and they get paid that commission. They're commission based. But it's at their best interest. It's all into them is helping you get that home and getting you across that finishing line, the finish line. Otherwise, there's no deal. However much time they've spent with you and they've worked with you, it doesn't affect, I mean, it doesn't benefit them if you don't get into a home. So it's in their best interest to take care of you. But anyway, that's it for me, guys. You know, if you like this content, please like, subscribe, comment below if you have any questions. Let's get a dialogue going. Let's talk about this stuff, because I still find it interesting, even being in the industry. And if you find it interesting, I would love to know what your thoughts are. So, all right, that's it for me. Take care. Peace.